What an exciting day for the apes it was today, everybody. Congratulations. We're going back up. We're going to the moon. Anyhow, I'm here today to show you how to take some profits off the table, how to take some risk off the table without selling a single share. This is what I personally do. It has worked very well for me, and it may be something that you might want to consider doing. So if you appreciate this information, make sure you smash that like button. If you're new here, make sure you hit that subscribe button, because we'd love for you to join our family so that I can teach you how to make money. So what I want to show you guys today is how to get your tendies and eat them too, and also how to get your cup of ranch on the side. Here's the thing, we're going to talk about selling options. I know that people have probably told you to buy options, or you've probably heard people talking about buying options and buying options on AMC. For today's video, we're mostly concerned with call options, not put options, but I'm going to show you that it would probably benefit you more to sell options rather than buy them, or at least in most circumstances. I think you'd be better off being an options seller than being an options buyer. Now, AMC does have weekly options, and today being the expiration date for this week, well, you're not going to get much juicy premium selling these options. But if we go just a week out, okay, let's go to June 18th, and the stock's been running up. We're up like 10.6, 10.75% today. So as you can see, these options, you know, they're going up. They're up quite a bit. This thing's up 10.68%. How much are these up? Pretty much 2.5 times that, which is wonderful. And when we're looking at these prices here for each contract, you know, each contract controls 100 shares of the underlying asset, which would be 100 shares of stock. So this $8.15 is actually $800.18 you're collecting. You sell somebody a call option. Let's say you sell them the $52 strike price. You collect $623 theoretically. Now I'm going to go over something else about that in just a second, but you would collect this premium, okay? You get to keep this no matter what. Whether the share price of AMC actually exceeds this strike price by expiration or not, it will not matter. You get to keep this premium because that's what the buyer of that option is paying you in order for you to give them the right, but they're not obligated to now. They just have the right to buy AMC or 100 shares of AMC stock for $52. And as you can see right here, the break even would be $58 nearly. Keeps changing on me, so it's kind of tricking me a little bit, but yeah, $57.95 is the break even, because if you were to pay this and then you still have to pay that, well, this is what you come up with. So you would add the premium that you're paying plus the strike price, and you get the break even price. Now, remember, we're going to be the sellers of this call option. We're not going to be the buyers. So if we sell, this is what we're going to get total. That's the premium you're collecting plus the strike price that the buyer has to pay before they can get their 100 shares. So take a look at what the price is right here, okay, per share. Okay, let's just say $4,700, okay, for 100 shares. Well, you're collecting $5,788 if this hits the strike price before expiration, and if that's assuming that the buyer calls you out on that contract. Your chance of profit on this is 75.98%. Here's the thing, okay? If, let's say, AMC stock just skyrockets, okay, and takes off to $100 or something, then, okay, so you're still not going to lose money, but you're going to lose potential profit. You're basically capping yourself at what you're getting paid right here at this break even. So you get nothing more than this, no matter, you know, how much above or how far above the share price goes above the strike price. So that's the trade-off. So you want to find premiums that are juicy, but you still want to sell these contracts at a high enough strike price to where it's not likely to hit. So let's see what some of these other premiums are looking like. These expire in 7 days, okay? And I'm going to explain something else to you that works in your favor in just a second. But let's say that you want to play it super safe and you want to sell the $100 strike price because you don't think that by the 18th that AMC is going to hit $100. So you would collect $148 because you're going to sell that. Okay, that's your premium. So that's just free money right there. $148, $149 now that you get to pocket if this thing expires, without hitting that strike price or going above that strike price. So your total break even is $101.51. Now, for some of you, you may be thinking, well, heck, I'll sell my shares for $101. If you are okay with having to sell your shares, being forced to sell your shares, okay, 100 shares of AMC stock for $101.52, then you could sell this and not have to worry about it. Now, this premium is going to go up if the underlying asset goes up, meaning if the share price goes up, the premium here is going to go up. And let me show you a neat little trick here. So if we take a look at this, one thing we need to know about is theta, okay? This negative 0.4087, well, that's how much value times 100 these contracts, each contract loses on a daily basis. Now this updates too because these are called the Greeks, by the way. There are other factors that influence this, but we're going to try to keep it very simple. So we're just going to say that this updates, okay? Now, for every dollar move in the strike price, or I'm sorry, in the share price, the stock will go up by $14.36. Okay, so if the stock it's $47.45 right now, if it goes to $48.45, theoretically, it's going to go up by the delta value. Okay, with this specific stock AMC, we're expecting some big catalysts. We've got things going on, so this isn't a normal stock. This isn't a normal situation. So you're taking a risk of capping your profits, at whatever the break even is on this. Okay, so it's the 100 strike. So yeah, your break even, you're capping your profits to 101.59. Okay, if you're selling that. But look, your chance of profit is 94.95%. You guys can be collecting this, on a weekly basis. You guys can go out a little further and collect even more premium. So let's take a look at that. The $100 strike price about 2 weeks out. Look at that. $390 you would be collecting. You still got a 92.46% chance of profit. Let's go out to July 2nd. Let's take a look at these juicy premiums, okay? Look at that. $583 in your pocket. This is going to get crushed. You're going to experience an IV crush, which means the implied volatility is going to go down because of the velocity at which the stock is trading goes down or decreases. So, yeah, you're going to lose a lot of premium there, which means you're going to profit off of that being a call option seller, okay? And this is exactly why you do not want to buy options, because there are a lot of factors working against you. But when you're selling, you're pretty much giving yourself the best possible chance. The person that bought the call options contract, they do not have to wait till July 2nd to exercise it. They can exercise that contract and call you out on your shares if the share price exceeds $100. Okay, so that's what you have to understand. That's your risk. Your risk is that you're pretty much capping your potential profits. But in most circumstances, I think you're going to be pretty good. Just, go to a high strike price, because that's what you're going to want to do. So I'm going to take you to January 20th, 2023. this $145 strike price, just a few days ago, this was like 4,000 something dollars, maybe even 5,000. Okay, now it's at $17, which means $1,700. So if you would have sold at this strike price, you would have collected, a lot of juicy premium, and you could then buy this contract back, okay, to close it, and now you no longer are obligated to sell your shares should the share price go above this $145 strike price by the expiration date. Now, this is a long ways away. There is that trade-off that you could be capping yourself, but at the same time, if the stock ends up stalling on you or, dropping like we saw it do last time or here in the last few days because the hedgies are trying to play games with us, well, this is a good way to collect a bunch of premium. You don't have to sell these calls on all of the shares that you hold. Just sell it on a couple of them, if it makes you feel better. And you can use that premium to buy more shares of the stock. You can definitely do that. So when you're buying these options contracts, you have got to pay attention to the bid and the ask spread, okay? The bid-ask spread. The bid is $17, which means $1,700 is what you would be selling this for. The ask is $1,750, which means you would be getting $1,750 for that one. But here's the thing. So normally, what you see on Robinhood, if I were to try to sell or buy this right now, they're gonna use the mid price, so you would see $17.25. That doesn't necessarily mean that this order will fill at $17.25. You've got to have a buyer, and right now the highest bid is 17, or at least that's what we're seeing. So yeah, pretty much if you want your order to fill immediately on this, you may want to start with whatever the bid price is, which would be $1,700. You would use 17. If you have a little bit of time, some patience, you could start off with the ask price, but on Robinhood, it's pretty much not going to fill at that price, I can tell you right now, unless the share price starts shooting up. In that case, you could get filled there, but most of the time, if you want to get filled very quickly, go with the bid price. And look how it's changing there. Oh my goodness. Whenever you see a very wide bid-ask spread, oh wow, it's tightened up. Man, what a bunch of manipulation. But anyhow, if you see it really wide like this, $16.45 bid and $17.50 on the ask, that's letting you know that the market maker is uncertain of what's going to happen. So they're trying to make this very wide to protect themselves. When you're selling this, you're going to sell it pretty low at, like, let's say $16.20, $16.25, $16.30, something like that. It's going to show the mid price. So I don't know what the mid price is right off top, but it's going to show the mid price between, let's say $16.90 and $17.50. So it's going to show the value like it's $17.20. Okay. So you're going to be at a $30, paper loss, or that's what's going to be reflected in your Robinhood account. Don't worry about that. What's going to happen here is that every day this contract is going to lose 0.0265 in theta value, okay? So, of course, we multiply that by 100, and this is what the stock loses every single day while the stock is either not moving, like so stalling out, or not going in the direction that it's supposed to be going in, which is why you want to be an options seller, not a buyer. But should that stock, should that short squeeze kick in, well, it's going to be a whole nother story. While I have you here, I wanted to quickly tell you about the brand new First Trade app, available for mobile or PC. The platform will give you access to powerful and easy to use tools and allows you to trade with less restrictions, zero commissions, zero fees, and you can use the first link in the description below to download a free stock today without having to deposit any money. This will greatly help out the channel and is always appreciated. And now back to your regularly scheduled programming. Congrats, ladies and gentlemen, you've made it to the end of the video. If you like what you watched, make sure you subscribe because I put out videos just like this one every single day. And please do me a favor and smash that like button if I helped you in any way, because it really goes a long way in helping the channel out and keeps me motivated to make videos every single day. Now, there's a lot of work involved, a lot of research, and a lot of time and effort into editing and putting these out daily for you guys. You can subscribe from your screen right now. Or if you want to watch one of my other videos, I'm sure YouTube has some good content picked out for you on the left-hand side of your screen now. Thanks for sticking it out with me till the end, and I will see you guys in the next video.